We're seeing that market in your country under pressure. At the same time, we are also looking at a market that has been looking at what appear on the surface of it to be very, very good results. Why is the market under pressure when the results appear to be good?
Well, as you said, it appears to be some kind of a contradiction in the sense that there's some very good earnings results that are coming out with dividends, bonuses, splits, and the like. But the market, again, is not seen to be responding to this. But I think this is largely because of two factors. The immediate factor is a jump in inflation, which was by and large expected. But the more discerning factor, I think, is expectations about rising inflation on the back of higher fuel prices based on the political uncertainty or political turmoil that's playing out in parts of the Middle East and North African countries. So I would say it's really the market looking forward as opposed to looking, in terms of the past.
So what's your sense then? Because we had results coming out of Equity Bank today showing an increase of 71%. I mean, that's a big jump by any measure that you'd like to use.
I think by and large, the results that you're seeing had more or less been expected, in the investor community, and as had also been largely expected, banks were definitely going to be the ones to surprise investors and continue buoying up the market. To a certain extent, this has actually been the case because when you compare the performance of banks compared to companies in other sectors, especially manufacturing, there's a marked difference in terms of banks are significantly doing much, much better compared to companies, in manufacturing and the like. But I think by and large, it's basically investors trying to look for information that is likely to give them confidence as far as the coming few months are concerned.
Yeah. Now, we had Safaricom today coming under heavy pressure, down 3.6% on the day to close at 4 shillings per share. Now, is that a surprise for you, given how well they appear to have weathered the coming of Bati?
Well, to a large extent, it's more or less in line with investor expectations. And I think as we draw towards the year end, which happens to be actually this coming month, which is March, we should expect that price to probably come under pressure as the investors continue to factor in all these price war effects and their likely impact on the company's earnings. So I think by and large, it is expected that the company is likely to post lower than expected full year results. And I think that is what we are seeing, being factored into the share price.
Yeah. Do you think we have come to the end of the price wars, as you refer to them? Have we seen the worst of it, particularly given the fact that we have heard the government coming in and saying perhaps some of the prices that are being proposed are uneconomical and perhaps may endanger further investment into the industry?
I think from all sorts of information that's in the public domain by now, we might just have seen an end to the price wars, and more so especially on the side of voice, prices on calls, voice calls. So we are yet to see what other strategies, the various players in the industry are likely to come out with on the table in terms of winning market share. But I think on the voice side, by and large, it is expected that, beyond a certain point, you'd actually be cutting to the bone. And I don't think that would necessarily be in the best interest of the mobile company shareholders, and more so even in terms of consumers alike, because sustainability is a key thing. So I think we might have seen an end to that. But probably what is more fundamental is the impact of a lasting nature, so to speak, that is going to have on the telcos' revenues and earnings moving forward.
Absolutely, and I'm sure that's one that investors will be looking at. But let's move on to a good news story. We've got Sasini up 5 cents today at 11.55 shillings, and we also saw some activity in Ria Vipingo. Is there any sense you're getting that investors are rotating out of our commercial and industrial services sector, the financial sector, into agriculture, particularly given the very good prices that we've seen around tea?
Well, tea prices definitely fared well, up to and including the latest reports coming out. Tea is definitely going to be a very good, performer. Again, looking at what's playing out, like for instance, when the easing of tensions, political tensions in Egypt, which happens to be one of Kenya's key export markets as far as tea is concerned, is definitely a boost as far as tea producers are concerned. But also another factor I think that's playing out is a weaker shilling definitely gives a boost to exporters and in particular tea companies. So you're likely to see investors moving out of companies that are perceived to take a very, very significant beating from high inflation to companies that are likely to benefit in the, in the new environment of high inflation and perhaps a weakening shilling and the like, assuming of course that demand for tea and other exports will remain as it has been.
Yeah. So what's your sense then in terms of direction for the overall Kenyan market, given all these factors that we've been talking about? Good tea prices on the one hand, inflation accelerating on the other hand, and good results coming through on the banking front.
I think by and large, for me at least, the greatest indicator is actually what is playing out in the parts of the Arab nations. And I think that is definitely going to have a bearing in terms of moving forward, because by and large, in as much as food prices are expected to be high because of the effects of drought and the like, I think the biggest determinant as far as economies of most countries is concerned, and I'm talking about non-oil producing countries, is the price of oil. And I think as long as crude oil prices continue to trend upwards, then that is going to continue sending jitters across the markets, and that is definitely going to dampen equities. So for me, that's really the key factor to watch. And of course, any activities as far as extreme weather is concerned, given their impact on agriculture.
So with inflation on the march then, and all these fears that you talk about on the horizon, are we looking at cash beginning to come into play here, or is that still too taboo? I mean, the interest rates remain low.
Well, there's no indication so far when you look at the local, the dynamics as far as government borrowing is concerned, as far as liquidity in the money markets is concerned, that's likely to suggest a significant climb in interest rates from the gradual pace that we've been seeing in the last few weeks. So I think other than the government's demand for money for budgeting and all that, and I don't see a very, very pressing need in the short term. By and large, short-term rates are likely to remain within single-digit levels, and I don't see that hitting so negatively on equities. So by and large, I think in as much as cash is definitely going to be a preference compared to certain equities, there are still very good opportunities on a selective basis as far as equities are concerned.